some more swings today. Just watch out for it. Nevertheless, Manish Sonthalia joining in this morning, Director and Chief Investment Officer at Emkay Investment Managers. Manish, great to have you on NDTV Profit as always. We love our conversations with you. You know, this is the time of the year where we do a bit of a recap of the year that's gone by and what we're looking forward to. So let's start with the recap bit. Survival, resilience, if you had to really describe what the Indian markets have been through. And at the end of it, everyone wondering why they haven't made as much money as they thought they would.
Yeah, so the headline numbers seem to suggest that we are closer to or just about at the all-time highs. So no need for extreme pessimism. But if you look deeper into the market dynamics, bulk of the market is still bleeding very badly. And that is why you really don't have that sort of a euphoria which is associated with all-time highs in the market. Very few stocks have basically made it. The 10, 12 large cap stocks are basically at, leading the market from the front. So headline numbers don't really seem to suggest the true picture of the market. And I think going forward, things look pretty decent from these levels. No need to be bearish, according to me. Earnings pickup will happen both in the broader markets as well as the headline numbers, and one needs to be selective. I think one thing which is going to happen is basically sector rotation. The high-flying sectors of the last 1 year, or last 2 years, which is roads, railways, defense, EMS, there you don't have any valuation comfort. Today, the markets are giving you a very clear signal that valuation euphoria will not be entertained, and there is going to be correction in spite of earnings. So I think out here, if you have discounted earnings for next 3, 4, 5 years, basically it's not going to be acceptable is what the markets are trying to tell you. But on an overall basis, FY26, FY26, 27 looks pretty much better than FY25, 26.
Manish, morning, Niraj here. Just a point, for a lot of people who are looking at the markets currently and thinking this excruciating pain in the portfolio has never happened before. I guess this tape has played over and over, right? We've seen this times in the past. 2017-18, if I'm not wrong, the mid caps went for a toss. Whenever this turns, right, Manish, and you mentioned that earnings growth will come about, do you expect the turn in the quality mid caps and small caps, which are trading at very good valuations, to be very swift, or could it be gradual?
Yeah, so, it always looks like that the end of the world is here whenever you see these sort of meltdowns in the market. We have seen 2008, we have seen just before the COVID broke out, after the capital gains tax was introduced. I mean, it seems like the end of the world, and, you have stocks falling 30, 40, 50%. But I mean, it takes that much of a bold heart to, go out and buy in these sort of markets that creates your maximum wealth over the next 3, 4 years. And basically the mid-cap, small-cap story is a story for 3 years and above. I mean, if one was to believe that you would buy a mid-cap and a small-cap and they would give you exponential returns in the next 6 months, more often than not, they will further correct. And then from there, it is going to turn. So the proof of the pudding is basically earnings revival. And I think on a very high base, we are going to see earnings revival. My sense is FY26, 27, your mid-cap, small-cap earnings revival is going to be slightly better than the large cap, more like 15% plus. And at the end of the day, it is going to be about the specific earnings on your individual stocks and the valuation. I mean, there is no one size fits all in these sort of the markets. In the broader markets, it's a very large space. You don't have the luxury of deploying capital in just 1 to 100 in the large cap or 101 to 250 in the mid cap, and you get SIP flows and you keep buying those same very stocks and they get elevated valuation. The small cap space is a very, very diversified, number of stocks. And I would believe that there is some great value in the mid and small cap, provided you give it 3 years and above. And that is something which was lacking in the last 2, 3 years, that you start discounting next 5 years of earnings and still believe that the story is good. That is what the pain is all about in the current space. So I would believe that, yes, as like in the past, when there is blood on the street and you go out and buy, you get the maximum benefit.
Manish, hi, Alex here. And so let me extend that a little bit, right? To ask you, and also just a comment, if people thought that picking stocks from the broader markets was easy, the last 1 year has disabused them of that notion. But having said that, if you're talking about earnings that you're looking at and trajectory looking promising from the broader markets, as you pointed out, it's wide. And so therefore, what are those pockets that you're convinced that have rounded the corner that you're looking specifically at?
Yeah, so, adding to what you just said, picking stocks from the broader market is the most difficult form of stock picking that one could do. The easiest form of stock picking is basically the large cap space. And the mid and the small cap space is a lot of homework that you got to do before you basically take your call on the large number of stocks from within the large number of stocks that you have in this universe. Coming to which are the themes and sectors, I would believe that's a no-brainer that obviously consumption should make a comeback. You have platform companies, which are leveraging on technology, and basically these are intermediation businesses across domains. They would tend to benefit. Capital market plays have corrected and would offer great value at these levels from the next 2-3 years point of view. You have healthcare, you have rate sensitives, which is going to do very well over the next 1 year. So these are some of the pockets which I think is going to likely outperform the markets.
Right. Okay, Manish, I know you've been a big proponent of the capital market theme. In some sense, I think my fellow co-anchors will accuse me of sounding like a broken record when I talk to everybody about this particular aspect. But is there money to be made here? We've got a large IPO coming in from an AMC. We've got a recently listed tech broker, if you will, and a clutch of other old school businesses trading at very cheap valuations as well. Are you a buyer in this theme en masse, or are you picking and choosing specifics within this very wide bucket now available?
So look out for duopolies, because the profit pool in the capital market businesses is only going to grow over a period of time. And basically the profit pool within this space is going to get shared between very few number of players, apart from the broking space. And here also there is going to be a very massive differentiating factor, whether you are a brick and mortar or let's say physical or phygital broker, and whether you are an online tech platform, because the operating leverage benefit is going to be disproportionately higher if you have a massive market share vis-a-vis guys who have a lower market share and are catering to the brick and mortar or let's say the phygital space. So from that point of view, except for the online broking space, the rest of the space, I would believe that the sky is the limit. And you were to take the next 5 years, 10 years point of view, these are very high entry barrier businesses. You don't get market share in this space very, very easily. And 21 crore demat account, whether this is likely to be 50 crore demat account, the answer is a yes, because the equity penetration is just about minuscule in the country, even now. And you have 75 crore PAN accounts. So as the prosperity of the country increases, you have a larger number of players investing in the equity market, and these structural, the companies are duopolies or maybe 3 players, and so disproportionate benefit is going to come across the space. You alluded to the AMC space, the 30,000 crore worth of SIPs, and the top 10 players get bulk of these SIPs. These are again very high operating leverage businesses. Agreed that the TER is going to come down, but at the end of the day, you get paid on AUM. And the AUM, if everything's said and done, is going to double in the next 5 years, a 15% CAGR in the AUM, without any additional flows. And that the doubling of AUM would mean that your total income is going to double in the next 5 years in the AMC space, irrespective of any flows coming in. Plus you have the flows. And what is the major cost item in these? Basically people cost, which is 30% of the revenue.
Yeah.
So all in all, a very big space and a lot of money to be made in this space is my belief.
Okay. So we were discussing this morning, Manish, about Swiggy and the fundraise that it has, right? 10,000 crore rupees. And this is simply ammo to stay in the race as you have large players likely to come in and have significant competition. So you mentioned platform companies, but I'm just wondering whether it's difficult to pick right now, because if you pick someone and then a large conglomerate or a large global multinational comes in and deploys a huge war chest, your business model is finished.
So yeah, I believe that, business intermediation businesses leveraging on technology are going to be in a sweet spot. So obviously Swiggy, Zomato, Zepto, you have Flipkart, you have Amazon. These are all basically intermediation businesses using technology to connect the buyer and the seller, as a marketplace, or whether you have your own carrying inventory. The point out here is that, whether you get your unit economics right. If you're burning in a lot of cash, and this is also a reference to players who have very large, deep pockets to burn a lot of cash to gather market share. You can't get this business model right if you don't get your unit economics straight. And I think out here, only Zomato has got its business economics, unit economics correct out here, and rest of the guys are basically discounting a lot and getting turnover. So there's no point in buying turnover. You must be actually pulling business turnover based on your competence. And that is where the difference is going to be. So yes, it's become a crowded space. Zomato has taught everybody how quick commerce is done, and everybody is following. But it's a tough business. The rider economics, unit economics is not easy to get, even if you have deep pockets. So there are limited number of players who will have a right to win. And, very few players will take bulk of the market share, is what I believe.
Thank you so much for speaking with us. We hope to speak with you again before we close the calendar year and get thoughts on, what the plan is for 2026. Manish Sonthalia there. All right, corporate focus. We're speaking with Translate Live.